Hey guys, it's Doc's Market Minute for Wednesday, December 30th, and today continues part 2 of the top 10 lessons that the market has extended to us in 2015. And number 6 is that the market is not the economy. There is no correlation between the market and the economy. So in other words, what can be happening with your sense of where the economy is going? You may be thinking that the market or the economy is heading lower, is getting weaker, and you might be right. But that doesn't necessarily mean that the stock market has to do the same thing in lockstep. Remember, it's always looking 6 to 9 months down the road. And, sometimes we can see the market actually discounting the fact that the economy is going to roll over before that happens. Again, there's no correlation there, and it confuses people. And the opposite can happen, is that as the economy starts to slow down, we can have the opposite happen. We can have the market continue to go higher. And it's got people scratching their heads. It's got people going bearish on the market far before the market is saying so. So here's the thing, is if we quit trying to predict the future based on what we think we know about the economy or the market, then we'll do a lot better. And the way that we can do that is just to watch the price action, box in the price action. And if we start to see a change in polarity to the downside, then we know that the market is starting to discount future non-performance. But for right now, stop this business of trying to predict where the market is going based on where you think the economy is or is not right now. That's the lesson that the market keeps reminding us, and reminded us once again in 2015. Now, lesson number 7 that the market imparted to us in 2015 is, I don't think there was anything special about 2015, but it's another reminder that implied volatility is normally higher than the actual realized volatility. So you can see this, in this case, the graph on the bottom part of the screen here. The blue line is implied volatility. The red or pink line down here is the actual realized volatility of the market. And so what you can see is that the option chain is always overestimating the forward volatility of the market. And so essentially what you're seeing is that there's additional risk premium that's priced into the options because of this. Now, occasionally we're going to have realized, which is larger than implied, realized larger than implied, but it really doesn't happen that often where we have more volatility than we expected. Option traders are always really smart about forward discounting what they consider to be risks in the market. And as a result of that, usually they're overshooting a little bit in terms of assigning implied volatility values. So what does this mean to us? What does lesson number 7 really mean to us is that the edge remains with the option sellers. As long as you can manage your risk with your obligations, the advantage will continue to be with the option sellers. Now, lesson number 8 is very related to this concept, is that this is what I see when markets go into a very flat range, and this is actually the flattest range of price action that we've had since probably the 2006 timeframe. So the first half of 2006 until we got to the June 2006 correction, well, almost correction that kicked in. Okay, we had very flat price action here throughout most of 2015. And this is what I call a quiet and sideways market. We don't see this type of market condition very often. But the point here is that what happens to investors, especially newer option investors, is that they see price action like this starting to go sideways, and they think, oh, this is good stuff. I'm going to set up iron condors. And they set up iron condors above and below, and they start to get really confident in this strategy, thinking, wow, where has this been? Why aren't I using this all the time? And what happens is they start to add more and more position size as they get more and more confident, right? And it works. And it works, and it continues to work until they add so much position size that eventually one of these sides gets blown through. And guess what happens? These losses usually eat up all of these profits back here. I've seen this happen time and time again. So lesson number 8 here is that range contraction like this, when it does occur, even though it's a perfect setup for the iron condor, you know what's coming next. Range contraction leads to range expansion. So be very, very cautious. The longer that one of these moves occurs, the more risk that we have of a breakout or breakdown. So that's lesson number 8. Lesson number 9 that the market shared with us, and again, this is one that comes up all the time, and sometimes we have to remember this, is that we have to match the trading strategy, especially with options, to the actual realized price volatility. So it's not only just the implied volatility that we're matching, right? So typically what you're hearing is, okay, when we have big volatility or increases in volatility, we should be selling options. And when volatility is low, we should be buying options, right? You've heard that one before. But what about realized volatility? What about the actual price volatility? I'll give you an example here. When we have a situation like this, where we had, after this rally, we had very low realized, we had very low implied volatility down here, right? So that stands to reason at the top of a big rally, typically you have very low implied volatility. And so what you would want to do is something like a time spread, which is a short or a long vega trade. So it wants implied volatility to rise from there. Okay, so you set that up and all of a sudden you realize that you've stepped in the middle of a sideways and volatile character of market that we talked about yesterday in the first 5, right? So we go from this range contraction to a range expansion, and we went from a quiet and trending market, or in this case a quiet and sideways market, to sideways and volatile. So even though everything matched about the strategy from an implied volatility perspective, right, according to the book, what you find is that the price is actually still moving around a lot, and it makes it very, very difficult to manage a trade like that, which is placed at the money. So what a lot of people do is then they're getting whipsawed all around the place, where they're adjusting the trade or they're taking it off, and all of a sudden it bounces back up again. And it leads to very, very frustrating condition where the trade, according to you, according to all the experts, should be working great because implied volatility is low, but you've failed to account for the actual price volatility. So there's really 2 dimensions of that, and this is what the market is always trying to tell us, is that you've got to match what you're trading and make sure that you have an edge with that particular type of market character. Now, I know that there's folks that say that you should be trading the same strategies in and out every month, regardless of what's happening. But if you don't want to learn these lessons, then you'll pay attention to what the market is actually doing and what it's likely to do. And it will decrease your frustration if you match your strategies to what the actual price is doing. Okay, and so I'm going to finish off our list of lessons from the market from 2015 with number 10, and that is the market's trying to tell us right now to get ready for the next big trend. The next big trend. So it is going to be the equivalent of something. It could be like this, or it also could be a 2008 version. Like if we pull that over here, it could be one of these and it could be one of these. We just don't know. All we know for a fact is that we have a tremendous amount of non-linear price action like this just coiling up. This has been a sideways market for the past 1.5 years or so. And what this does is that range contraction like this leads to range expansion. So I'm not going to be surprised whether or not the market goes up from here, another 500 points, or if it drops 500 points from here. I know that a big move is brewing right now. That's what the market's trying to tell us. And yet there are going to be a lot of people out there that are deaf to what the market is trying to say right now and are going to be very, very surprised when we start to see massive movement. If we go back and look at each one of these conditions that has the same amount of nonlinear action like this. So this is the choppiness index down here, and it shows us the linearity of the recent trend. And the linearity of the recent trend is like next to 0 right now. It's very, very nonlinear, and this is a very typical condition where it's preparing itself, it's coiling that spring for the next movement. If we go back and look at each one of these situations that's over the 61.8, we see massive trends either to the upside or to the downside. So we know the potential is there, right? It's just a matter of understanding what the price action is telling us and which way the trend is going. We know that reversals start from the inside out. We know that propagation of a trend from smaller time frames to larger time frames will show us what's coming next. So we're tuned in for it. The market's telling us something, we're listening, and we're going to be on board for that big next trend. I hope you are too. And that's it for today's Market Minute, and frankly, that's it for the year. This is all that we can learn from the market this year. Those are the top 10 lessons from it. I hope you guys have a great year coming up. Terrific New Year's, and be careful of amateur hour. We'll see you back here next week. Take care.